Hello everyone, my name is C. Anuj Agarwal from Gyan IFRS. Today we're going to talk about the classification of an instrument, whether it's an equity or an liability. In India, when we have a certain kind of instrument, what we issue it, we treat it as per their contractual arrangements or whatever it sounds like. For example, if we are issuing a preference shares, we will be using it as an equity without any further analyzing its facts or terms and condition, which might indicate that it can be a liability as per the new requirement. Ind-As 32 or IAS 32, which talks about the presentation of a financial instruments. Today we just want to touch upon the basic or the very broad level classification rules, so that when you are analyzing any of the instruments, so you can use these thumb rules and you can identify quickly whether it's an equity or a liability. Ind-As 32 or IAS 32 says, if an issuer is who? Issuer who is issuing the instrument. If an issuer has an unconditional right, unconditional means there should not be any condition attached to that instrument. Meaning, the standard says, IAS 32, the issuer, once the issuer has an unconditional right to avoid the payment or to redemption or to set off the whatever for he has taken that instrument for. Like, if he has issued certain class of instruments to the holder, he should have an unconditional right to avoid that payment in cash or in the financial asset, whatever is the case may be. So, meaning, if there is no unconditional right, means issuer cannot avoid the settlement of that instrument, be it in a cash or in other financial instruments, then it will be in liability for the entity or the business or for the issuer per se. We will take some examples to elaborate it further. There are some instruments where the it will be redeemable. Redeemable is what? Redeemable is encashable. Like, when the whoever is invested on those instruments, he wants his money back, or he wants that amount what he has invested back. So if the instruments are redeemable at the option of the holder is who has invested in those instruments. If the instruments that are redeemable at the option of the holder, then it will be treated as a liability. Why? Because the issuer, he does not have an unconditional right to avoid that payment. Meaning, whenever the holder will ask the payment, he has to pay the payment. So in these cases, these instrument will be a liability to the entity. Another case, if we are analyzing the dividends on a non-redeemable preference shares, which are not discretionary. Discretionary means it's not something which is on the own will of the entity or the issuer. Then again it will be a liability to the entity, because they cannot avoid the payment of the such dividends. However, in other case, if those preference shares dividend are discretionary, means if the entity can say, hey, I don't have the cash right now, I don't want to pay it this year, I will pay in the subsequent period. So if they have their right to say no to settle that particular payment, which is in the instrument or it's attached to the dividend, then it will be treated as an equity. Equity is what? Equity is defined in the standard is a residual portion of the business. Like, if you are settling down your liability against your whatever the assets you have, so balancing portion, whatever will be the residual part, that will be your equity. So equity is something which the holder of the equity instrument will not come and ask for the cash. That's what the main bifurcation between the equity and the liability. Liability is something where the holder of that liability can come and ask for the payment. That is where the basic underlying the methodology behind that as per the standard. Another example, if the instrument has some feature which become redeemable only of the occurrence of some uncertain future events. Uncertain future events, for example, maybe some based on some stock market prices or interest rate, etc., which is out of control of both holder and the issuer, then again it will be treated as a liability. However, as per the interpretation of the standard, it says that if the transaction is not genuine, it's not genuine means it is something which is made for the purpose of defeating the classification, then these will be treated as an equity, because these redemption will be required only on the liquidation of an entity. If somebody wants to defeat or somebody wants making it not genuine, then the standard says that to making it liability, if it is not genuine, then it will be treated as an equity. Another example, there are some instruments where the local law, normally the local law might require to settle the particular payment as a dividend, which is permitted by the local law. So it is something which is not conditionally imposed on the issuer. So he can avoid that. I mean, in that he is not a contractually binded. So it will be treated as an equity. Another example, there is a clause which says that the instrument will be redeemable only at the liquidation of the entity. If that is there in that particular terms and condition of that instrument, then it will be treated as an equity, because equity is the residual part of the instrument. Another example is the putable instruments. Putable instruments which are redeemable at the option of the holder and issuer does not have the right to avoid such settlement will be treated as a liability. However, if the condition says that such put option can only be exercised at the time of liquidation, then again it will be treated as an equity. So basic underline or the thumb rule says that whenever issuer has an unconditional, not a single condition, means if the issuer has an unconditional right to avoid or to say, hey, I don't want to pay that, then it will be treated as an equity. Like it will be like you are you will be getting your portion or the value of that particular instrument at the end of the life of the entity, if the case may be. Anything else which is not, you cannot avoid, that will be treated as a liability. So it will be just like a glimpse of the presentation and the classification of the financial instrument. So it's what we can understand for, we have to go beyond that legal form of that particular instrument, because the classification will be depending upon the other terms and condition which can make it a equity to a liability. Hope this will be a useful for you. For further information, you can log on to www.gyanifrs.com. Thank you.